Hey everyone, welcome back to Corporate Decoder, the place where we see if these companies are truly earning their keep. Get ready for some Baldwin Insurance Group numbers that might make you do a double take. So, this is the Baldwin Insurance Group Incorporated filing their annual report for the year ending the 31st of December 2025. Think of this as their yearly report card for the public eye. It is a big document packed with details, but we're going to cut through the jargon to find the real story. Baldwin Insurance Group, known for its catchy ticker symbol WIN, is a pretty significant player in the insurance distribution world. They describe themselves as providing indispensable expertise and insights, aiming to give clients confidence. They've grown a lot through acquisitions, partnerships as they call them, and are focused on innovation and a holistic approach to risk management and employee benefits. They now work with over 3 million clients and have around 5,000 colleagues. Let's jump straight into the money for the year ending the 31st of December 2025. Their total revenues hit $1.5 billion. That is an increase of about 8% from the previous year. The main driver here is core commissions and fees, which grew organically by $98.5 million. This means they're bringing in more money from their ongoing business. Not just from new acquisitions, partnership activity added another $23.6 million. They also saw a small dip in income from their wholesale business, which they sold off. So overall, revenue is looking up. Now, where does all that revenue go? Their biggest expense is colleague compensation and benefits, which is understandable given their growth. It went up by $15.3 million, about 2%, to over $777 million. This increase is tied to their revenue growth and investments in new talent. Their colleague earnout incentives, which are tied to performance, actually decreased significantly, meaning they settled a lot of those obligations last year. Other operating expenses saw a pretty big jump, up 25% to $240 million. A large part of this increase, $19.1 million, is due to higher incurred losses and expenses related to their new captive insurance business. They also spent more on professional fees, likely from their partnerships and setting up new ventures like the reciprocal. Technology costs also went up as they continue to invest in automation and artificial intelligence. Despite the revenue growth, they reported a net loss of $54.2 million for 2025. This is a bit worse than last year's net loss of $41.1 million. This loss is largely influenced by non-cash items and other financial activities that we'll get into. But here is where things get interesting. When you strip out certain costs that don't reflect the day-to-day business, like interest, taxes, depreciation, and some one-off expenses, their adjusted EBITDA margin was 22.7%. This is a slight improvement from 22.5% last year, and it shows that their core business operations are actually quite healthy and profitable. So while the bottom line shows a loss, the underlying business is generating cash. Speaking of partnerships, the report details how they account for revenue from new acquisitions. They exclude the first 12 months of commissions and fees from new partners to get their organic revenue. For 2025, this organic revenue grew 7%, which is solid but lower than the 17% growth in 2024. This is because in 2024, they had a lot of newly acquired businesses that started contributing fully to organic growth. Let's look at their main business segments. The Insurance Advisory Solutions, or IAS segment, saw revenues grow 2% to $723 million. Core commissions and fees went up, but growth was a bit slower than last year. They mentioned headwinds from softening insurance rates, especially in property, and weakness in construction projects. The Underwriting, Capacity and Technology Solutions, or UCTs, segment is a real growth story. Revenues there shot up 16% to $544.6 million. This was driven by their MGA platform, Mississippi I, the new captive business, and their Capacity Solutions group. They're really pushing proprietary insurance products and alternative reinsurance capital. And then there is Main Street Insurance Solutions, Michigan S. This segment grew 6% to $297.7 million. Growth was boosted by the acquisition of Hippo's homebuilder distribution network and their national mortgage and real estate channel. However, they had some headwinds in the health business and their legacy Main Street business. Now onto the debt. As of the 31st of December 2025, they had about $1.7 billion in total consolidated debt. This includes $600 million in senior secured notes and over $1 billion in term loans under their JPM credit facility. In January 2026, they even added another $600 million in incremental term loans to fund more partnerships. This is a lot of debt, and it means a significant chunk of their cash flow goes towards just paying interest and principal. They also carry over $1.5 billion in goodwill on their balance sheet. Goodwill happens when you buy a company for more than its identifiable assets are worth, often representing the value of brand, customer relationships, or synergies. This is a big number, about 39% of their total assets. And it is a constant reminder of their aggressive acquisition strategy. They test this for impairment annually, and so far, no major write-downs have occurred. These guys love earnouts, which are basically promises to pay extra money to partners if their businesses hit certain performance targets after an acquisition. At the end of 2025, they had about $23 million in these liabilities, but the maximum they could owe is $50 million. What is really interesting is that for their big January 2026 deal with CAC Group, they could owe up to a whopping $250 million in contingent consideration. That is a huge potential future payout. Now for the risks, and there are many as expected, they're heavily exposed to macroeconomic conditions, and they specifically mention the impact of inflation on their costs, especially compensation. Volatility and declines in insurance premiums could seriously undermine their profitability. They also highlight the intense competition and their reliance on a limited number of insurance company partners. A major concern is their ability to keep and attract good people. Losing key executives or senior leaders could hurt their reputation and their ability to keep business, which is critical for a service-based industry like insurance. They also acknowledge that their growth, while impressive, might not continue at the same pace, and that increasing costs could make it tough to stay profitable. Like almost every company today, cybersecurity is a big one. They've invested in safeguards, but the risk of data breaches is ever present, and a successful attack could lead to significant costs, legal liability, and reputational damage. They also admit they've experienced some security incidents, although none have been material yet. Looking at the actual financial statements, they have total assets of about $3.86 billion and total liabilities of $2.78 billion as of the 31st of December 2025. Their total stockholders' equity is about $1.08 billion. That long-term debt we talked about earlier sits at over $1.6 billion. After accounting for discounts and issuance costs, the receivables from premiums, commissions, and fees are a substantial $342 million. On the liabilities side, a huge chunk, over $720 million, is fiduciary liabilities. This represents money they hold for others, like premiums collected to be sent to insurance companies. Commissions payable is also significant at nearly $51 million. For the year 2025, their net loss attributable to Baldwin was $33.8 million. This is on total revenues of $1.5 billion. Their basic and diluted loss per S-hair was $0.5. Remember though, as we saw with the adjusted EBITDA, this net loss is heavily impacted by non-cash items. In terms of cash flow, investing activities used up a lot of cash, $140 million, mainly due to paying for new partnerships and capital expenditures. Financing activities, however, provided significant cash, over $203 million, primarily from borrowing more under their credit facilities and refinancing debt, which allowed them to fund these investments and pay off some existing debt. One really unique aspect here is the tax receivable agreement. Basically, when these original LLC members exchange their units for stock, it creates tax benefits for Baldwin. The agreement says Baldwin has to pay 85% of these savings back to those LLC members. This is a recurring liability, and as of the 31st of December 2025, it was about $4.5 million. This agreement can also lead to significant cash outflows in the future, depending on how tax laws and their ownership structure evolve. So, what is the story here? Baldwin Insurance Group is a company that is all about growth, especially through acquiring other businesses. Their revenues are growing nicely, and their core operations, as shown by adjusted EBITDA, are performing well. However, they're carrying a lot of debt, and their recent net losses, while impacted by non-cash items, are still worth noting. Their strategy relies heavily on successful partnerships and managing the integration of those businesses, which always carries risks. The future looks busy with more partnerships planned and a big shareholder agreement that could influence decision making. It is a classic growth through acquisition story with all the financial complexities that come with it. What is your take on Baldwin Insurance Group's strategy and its financial health? Let us know your thoughts in the comments. If you found this deep dive useful, please give this video a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our community on Discord. The link is in the description below. Thanks for watching, and we'll see you next time.